Yes, at first, yeah, just welcome everyone. It's so great to be able to have you, and obviously, it's so great to be able to have you, Michael, just be able to join the conversation. Obviously, you really need no introduction. Currently the head of Consilient Research at Morgan Stanley Investment Management, Counterpoint Global. I think that we had first interacted back when you had been at your previous company. So you've been the director of research at Blue Mountain Capital, and I still have fond memories of doing that guest lecture at Kinshuk Jurass class at Columbia, and then just getting the chance to sit down with you for, I don't know, 45 minutes or an hour, just talking about actually the sort of stuff that we'll be talking about today a little bit. So yeah, that was one of those moments I think I'm never going to forget. But yeah, needless to say, a best-selling author, Expectations Investing, and many, many other great books that I highly recommend, The Success Equation, et cetera, and chairman emeritus of the Santa Fe Institute. Just a variety of different things. Obviously, just an expert at such a wide range of topics. So hopefully we'll be able to just dive into one of them today. But really, couldn't be happier to be able to spend just a bit of the Friday morning talking about this stuff with you.
Thanks, Dan. I'm thrilled to be here, and this is going to be a fun conversation.
Maybe just to kind of get started, love to hear more. Actually, first, how did you get into investing in the first place?
Yeah, I mean, so my background very quickly is, I went to college and was actually a government major, so I didn't study economics or finance or business in any formal way. One thing I should note is that my high school guidance counselor really wanted me to apply to engineering schools, and I actually applied to a bunch of engineering schools and got into a bunch of engineering schools. So he wanted me to be an engineer. So the reason I mentioned that is because I was even though I was a government major, I was always very comfortable with numbers. And my first job in 1986 after graduating was on Wall Street working for Drexel Burnham Lambert, which at the time was a very hot firm. That was Mike Milken sort of cranking, and it was a training program, which was perfect for me because for someone that was coming into there was the remedial component of it and so forth. So I'll just say that, when I started, I just the jargon, the rules of thumb, I was like very much overwhelmed. And about a year into the program, one of my colleagues in my program, Nick Rippostelle, gave me a copy of Creating Shareholder Value, the Al Rappaport's book. And I have to say that it was nothing less than, for me, a professional epiphany. And there are three things in that book, Dan, that I'll just mention very briefly, because I think they're all things we're going to talk about, and they're all very resonant with the work that you've been doing. The first thing he talks about in the book is, well, he talks about a lot of stuff, but he says it's not about accounting earnings. It's really about cash flows, right? And that might even be more important today than it was 40 years ago when he started to write that, right? So, for example, you think, you buy a machine for $1,000, it's going to have $1,500 of cash flows with a 5-year life. What do you do accounting wise? You put that on the balance sheet as gross property, plant, and equipment. You depreciate it over the 5 years, and then you have earnings that are greater than the depreciation. So it obviously contributes to net income. Now you imagine in your world, you're going to acquire a customer. It's going to cost you $1,000, and they're going to have $1,500 of cash flow. So NPV positive, right? Exact same conceptual investment. But now we're expensing the customer acquisition costs, right? And in fact, the more of this you do, the more your losses mound, right? And so understanding, I think, getting back to what we call the basic unit of analysis, and I think the work you've done has been extraordinary in helping people like shine their spotlight specifically in understanding the basic unit of analysis. The second thing he talked about, and I think even at business schools, we do a bit of a disservice. We teach strategy over here, right? So 5 forces and value chains and game theory and all that good stuff. And then we teach finance over there. But if you're involved in the world of investing, strategy and valuation are linked, right? So you can't really do a thoughtful valuation without understanding strategy, and the test of a strategy, obviously, that it creates value. So that was the second lesson, and I'm sure we'll come back to that. And then the third thing, obviously, the big one is stock prices reflect expectations, right? So chapter 7, the original book was called Stock Market Signals to Managers. His audience was corporate executives, right? Some of whom we might have on our call today, but obviously, to state the obvious, is obviously relevant for investors as well. So in that training program, we went through different rotations. The rotation I liked by far the best was equity research. I think it captured a lot of the things that I found to be really valuable. And so I had a few working up to it, junior analyst jobs. And then my sort of big breakthrough was becoming the food industry analyst at First Boston in 1992. So the First Boston became CSFB and then became Credit Suisse, and now is no longer. But that was a stretch. So very quickly too, I'll just mention, I obviously love being an analyst. I thought it was great. But interestingly, I would go to talk to my clients and they'd be like less interested in Kellogg or, like Campbell's soup, or more interested in how I thought about valuation and strategy, right? So they were sort of pulling me into more of this kind of higher level work. And also I'll mention when I was a young analyst, I made a point of going to the morning meeting. So probably people know this, but at sell-side firms, every morning there's a research call where the research analysts line up and talk about their views, upgrade or downgrade stocks, or give updates or whatever it is. Then the sales force listens, and then they go out and call and talk to clients. But I would go every day just that when I was there for two reasons. One is I wanted to learn about other businesses. And second is I wanted to hear who was effective at communication. Right. So in other words, you can have great ideas, but don't communicate them well. That's not going to go very far. And you can have dumb ideas that you communicate really well and people pay attention to them. So you want to do both of those things well. And I think that actually gets into we might get into some stuff on disclosure. I think that's also important. So that led me to be offered the job as equity product manager. And then, I ran that call. And then I had withdrawal from not doing research. So actually after 2 years, I went back to be chief U.S. investment strategist at Credit Suisse. And I really focused a lot on process. Now, quickly, 2004, I joined Bill Miller at Legg Mason Capital Management on the buy side. That was my first big job on the buy side. And Dan, I think the other point of connection for us, I first wrote about customer economics in not a very super sophisticated way, though, in 2004. So almost 20 years ago, a lot of that work was inspired by Fred Reichheld's book, The Loyalty Effect. Now at Counterpoint Global, as you mentioned, part of Morgan Stanley Investment Management, we're an active fundamental equity team. We're long-term oriented. We try to think about sustainable competitive advantage and uniqueness of businesses, relatively concentrated. And so I know that's a very long-winded answer. We work with our team on process, and we also do research. But I guess to summarize sort of the key points, when I read, your 2017 paper with Pete Fader and Bruce Hardy, and I saw endnote number 1 was Rappaport. I was like, I fell out of my chair. I was like, this is awesome, because I'd never seen anybody who was focused on the customer very appropriately go through the full exercise to get it down to true cash flows and value. So that was awesome. Second is the tie into expectations is just, I think, very powerful. I think the work you've done and the work in expectations investing are sort of a match made in heaven. And with that central focus on the basic unit of analysis is really hard to beat. And, I had written about this topic before, and I applied some of it in our own research, but clearly you took it to a whole different level, which I think was really exciting. So, we wrote another piece about this a couple of years ago, I think deeply, deeply inspired and in fact guided by your work, which was really powerful. So that's, I know, is a very long-winded answer to that question, but I think that it sets the table for a bunch of the stuff we may get into now.
Yeah, but all the credit to that site, to Rappaport, I got to give to Bruce Hardy. He was our third co-author, but obviously as part of that, we were diving in as well, and drinking a lot of that Kool-Aid. So it's but yeah, for those who haven't read him, he's an amazing thinker.
I'll just mention, so Al's he's fabulous. He's amazing. He's 91 years old. And, we talk frequently, and he's still like not only an amazing mentor and teacher, but like a font of ideas. So it's extraordinary. And not obviously the impact he's had on me, but just as a great person, a great teacher, a great friend, great collaborator. So, yeah.
Yeah, I'd love to dive, obviously there's a whole bunch of different directions we could go in. Maybe the one thing I would say, what struck me the most when we came across that original piece that you had written, back in the day, was, I think that the seminal site that people will typically give to this kind of area of informing valuation with customer activity is this paper by Sunil Gupta, Don Layman, who was at Columbia. And then they had a third author as well. But I think that paper was published in 2004. So, so your writing was kind of, it was right back then. So, yep. So it's, that was really path-breaking. I guess what could be interesting is, so obviously love to kind of give a little bit more background about expectations investing. I know some of the audience may already be familiar with it, but kind of that general concept of there's not a whole lot that we know, but the one thing we do know is we know that the price is X, and the price is reflecting, this view of what may happen in the future. And so, instead of just projecting out, we kind of take that price and say, what does it mean? Obviously, I'm sure you can give a much more eloquent kind of description of that. As we think about the way of kind of marrying that with customer-based corporate valuation, obviously kind of the intuitive way would be to say, it's not just telling us about, well, it is just telling us about revenue growth and profitability. But we can kind of further decompose that revenue and the profitability into, adoption, and what's it saying about retention? What is it saying about contribution margin? Just love to hear kind of more your thinking about that, how that could be done. And then, love to kind of dive in a little bit more into some of the concepts from expectations investing and how they could help just kind of do that in a more practical sense.
So Dan, if you'll indulge me, maybe I'll spend just 2 minutes summarizing expectation investing. I think you just did a great job, but I'll give a little bit more detail, and I'll try to sprinkle in, like you said, sort of linking it back to customer-based corporate valuation. So, the first point, as you pointed out exactly correctly, the only thing we know is the price, right? So the step one of expectation investing, of which there are 3 steps, is to say, like, what's priced in today's stock price? And the typical way we do that is by trying to glean sort of consensus value drivers, exactly what you point out: sales, profitability, capital needs, cost of capital, all that kind of stuff. And we're using a discounted cash flow model, right? So we're not using multiples. We are using a proper valuation model. And in a sense, we're trying to read the mind of the market, right? So the question is, what do you have to believe to justify today's price? And maybe the metaphor for that is like, where's the bar set for the high jumper? And I think one of the key steps, the key points in step one, is to really try to be somewhat like neutral about it. Like, don't have a judgment just yet. Just try to figure out what has to happen. Step 2 is introducing strategic and financial analysis to assess whether those expectations are too high, too low, or gee, they're about right, and I've got nothing to do. So history is obviously a good guide for that, but the output is really, in our work, is scenarios, right? And so you're saying, like, how good could things be? How bad could things be? What's the most likely scenario? And almost all those things importantly start with sales. So I'll just say, Dan, just to triple underscore this, I think the one thing that jumped out at me about CBCV that's so powerful and really, really important to valuation is the ability to forecast sales intelligently. And I think you as an individual, not just like in this work, but just broadly speaking, have done extraordinary work, right? So we call this the value trigger, the most important thing that drives value. And getting a beat on that's incredibly important. And something like the customer cohort chart, C3 is if you can have, obviously, if you can do it within a company, it's amazing. But if you even cobble it together as an investor, it's an incredibly powerful tool to do that. So we like to come up with scenarios, usually 4 to 6 scenarios, and then try to probability weight that, and that generates an expected value. And then step 3 is, sort of the buy, sell, or hold based on discount or premium to expected value, right? So that's it. And there are lots of other things we talk about in the book. But maybe I'll roll right into what I think are the synergies with customer-based corporate valuation. And there are kind of 2 or 3 aspects I think are really important. The first thing I'll just say is, look, all modern valuation at least, goes back to Miller Modigliani, 1961, right? So if anyone is like, where's this all start, is 61 Miller Modigliani. And they had this incredibly powerful construct in there, which is, they said, look, you can think about a business in 2 pieces, right? Sort of a steady state value and a future value creation piece, PVGO. By the way, Rappaport called it pre-strategy value and the value of your strategy, right? These are all very consistent concepts. And Dan, what I really liked is trying to map that a little bit to your work by saying steady state, we'll say, is roughly the current customers, right? Who are the customers we have in our base? What are they doing? What are their characteristics, and so forth? And then the future value creation is our future customers, right? So then we have to think about, on the margin, what's going to cost to acquire them, what are their economics going to look like, and so on and so forth, right? So the first interesting question is a very simple one, which is, what % of the value I'm paying is in the current customers, the current customer base, versus what's on the come, right? And that's really interesting. And that's clearly an expectations thing, but the tools you provide are very powerful. Second, as I already mentioned, the key value driver is sales, and there is no better way than yours to forecast sales that I know of, especially for these kinds of businesses. And I know that your models have been uncannily accurate in sort of forecasting. That's really powerful, and I think I've never seen anything as good as that. And by the way, even if you don't have a perfect forecast, if you do build a C3, you have on a piece of paper an incredible template for debate, right? So you can think about how you might approach trade-offs and so forth. Mm-hmm. And then the last thing I'll say is, look, what I love about what I love about the work you guys are doing is that it's actually complete, right? So Wall Street, as I mentioned, loves heuristics, loves these shorthands, right? One great example is LTV to CAC, right? Lifetime customer value divided by customer acquisition cost, right? But again, it does not reflect all costs. It doesn't get including the cost of capital. It does not get you all the way down to value. And so the idea of just making sure that we sort of finish the job, right? Go all the way to thinking about value. So, to me, CBCV puts the meat on the bones of how value is created in a way that I don't know any other framework has done. So that's incredibly powerful. So that really is the synergy. Is that now once we have a sense of what's going to happen, I mean, what's priced in, we have a really robust toolbox to figure out whether those sets of expectations make any sense.
Yeah. It's kind of funny how funny or ironic that I find obviously kind of by construction, young firms are going to get most of their value from future customers, and they have very few current customers.
That's right.
And so it really is on some level just fundamentally much more uncertain. But at the same time, if you are getting most of your value from older customers while your business is more predictable, it's probably slower growing.
That's right. That's right. That's right.
Yeah, so it's kind of like, well, what would you prefer? I guess as an investor, it's really kind of hard to say.
But I think what you prefer is to know where you are in that whole discussion, right? Like that is, you might make your trade-offs, and obviously, like you said, if it's more on the come, it may be a little bit riskier, much more uncertain, or whatever it is. So yeah, I just think that having that conversation, being frank about it, understanding what the various components are, and I know you shared case studies, for instance, where this is just really nicely done. It's very tractable. It's, again, each item is broken out. We have what we know is sort of already happened, but then you can start to think intelligently about what's happening on the margin. And so I just think that knowledge, that approach, that understanding, and that framework just really helps you think about the problem much better.
Yeah, thank you. It's I'd love to dive into just and you kind of alluded to a bit with sales as kind of being the key driver oftentimes, and we'll kind of think about sales growth and profitability, but how a lot of times the profitability is being driven by the sales anyway. So it comes back to this. It's like sales, and sales. There's that notion of the expectations infrastructure, and I think a lot of people, they benefit just from hearing a little bit more about that. And then specifically then, the one thing that I've often just been, I won't say concerned by, but just as we think about running those 4 to 6 scenarios that you were mentioning, it's like the more dimensions that can be varied, just there's this curse of dimensionality, like there'd be all those many more different ways that we could kind of arrive at valuations, consistent with the current stock price. So just kind of reining that in, it felt like, expectations infrastructure could be one of the ways, by just kind of reducing it down to the most important drivers. But just love your thoughts about that. And then just.
Yeah. So Dan, I'll tell you like a 30-second story on this. So the original version of Expectations Investing came out in 2001. By the way, it came out September 10th, 2001. So just roll that back in your mind. Right? So a day before national tragedy, in the middle of a 3-year equity bear market. So like perfect timing, right? So anyway, but Al Rapport's obviously sort of the senior partner in this thing. He knows vastly more than I do, right? So like, we outline the book, and we have 16 chapters originally, and he's got advantage in everything, but we go comparative advantage, right? So, and so we had these chapters, and this, by the way, is based on his consulting practice. We had chapters on sales-driven businesses, margin-driven businesses, and investment-driven businesses. So I'm like, all right, very sensible. So I write the chapter on sales-driven business. I'm like, this is great. I'm really feeling good about it. It's like, it's in the can, right? And then I go to the margin-driven businesses, and I've got like notes and all this stuff. And then I start getting into it, and I'm like, I'm screwed, right? Because why do margins go up and down? It's almost always because sales go up and down, right? So this is exactly the circularity that you just pointed out. So that required us to step back. And I'll say that Al did the vast majority of this work. And we sort of said, okay, well, let's think about the three things that are common in all businesses: sales, costs, investments, right? Doesn't matter what business, anywhere, it's going to have those three pieces. But those are too blunt to put into our discounted cash flow model, the ultimate value driver. So we have to refine them to what we call the value triggers. So these are, and we, by the way, we talked to a lot of microeconomists about this. So these are the 6 microeconomic drivers of the ultimate, or triggers, we'll call them, of the ultimate value drivers. Or the factors. And, you know, the ones that are driven by sales are volume, price and mix, and then operating leverage and economies of scale. Operating leverage, economies of scale, slightly different concepts. But Dan, to your point, what this does, you're absolutely right about this curse of dimensionality. But what this does is allows you for the first time, I think, to organize your sensitivity work in a thoughtful way. So the first thing you can do, by the way, is just look at this and see how sales and margins have progressed and go backward and say, what contributed, if margins expanded or contracted, like what of these value factors played a role in that, right? And then you can think prospectively, you know, again, these are if then. So if we raise prices, what does that mean for volume? All these kinds of things, right? And again, we're running scenarios. So you can run a little bit free here, right? You can sort of say like, how good could things be? How bad could things be? But one of the key things is we're capturing that delta EBIT, delta sales relationship, right? In a way that I think is very difficult to do. And, you know, we've written about this specifically. Analysts and companies really struggle with this. They just don't, you know, it's fundamentally kind of a fixed variable cost situation, but companies are just not good at it. Revenues do really well. People just underestimate how profitable businesses can be. And if revenues drop off, people underestimate how bad margins decline, how quickly they decline. So to me, this is, you know, we call it the expectation of infrastructures, chapter 3. I think that, you know, I don't know if you feel like there are components of your work that are least paid attention to. I think that chapter 3, that expectation infrastructure is one of the least utilized tools, but in my way, the more I've been around this, I think it's actually one of the most robust things you can do to think through this. And again, set the stage for debate about what's happening. So why I'm so thrilled about customer-based corporate valuation, how it ties into this, is because we find that of these 3 value triggers, sales, costs, and investments, in the vast majority of instances, as you point out, it's sales that are the most important thing. So here you come along and say, okay, you know, there are more businesses related to customers. And oh, by the way, we've developed what is a fairly robust way to bottoms up, right? Do a better job of forecasting sales, not top down or through guidance. Heck, that's amazing, right? Because then I can take that and run through the value factors, run it through my model. And again, doing scenarios and get, I think, a very full and reasonable view of like what could possibly happen, comparing it to the price.
Yeah, that makes sense. I was going to mention too, just for the audience, definitely keep the Q&A coming. Hopefully we'll have a little time at the end, although I'm sure we could easily fill 2 hours just talking about this, but yeah, maybe we can leave just a little bit of time at the end to dive into some of those. But yeah, maybe just, I think one of the cool things is, you know, a dollar revenue can bring about very different margins depending on what's generating the revenue. And so one of the interesting things about the framework is obviously a dollar revenue coming from a newly acquired customer requires CAC. And oftentimes there's, you know, promotional activity that hits that you wouldn't have if the equivalent dollar of revenue had come from a repeat buyer who's been with the firm for 10 years. And so, you know, when you think about operating leverage, we'll often think about that in terms of those variable economics and how they can be vastly different, whether, you know, growth is coming primarily from acquisition versus primarily coming from that stream of repeat orders. So yes, that would be kind of one area where depending on the scenarios that you run, if you are kind of projecting out these scenarios where, you know, a lot of the growth is being powered by, you know, layering on the marketing spend to bring in a whole bunch of new customers, very different margin profile to that revenue than another one where, you know, it's not runoff mode, but it is kind of more, you know, just letting the existing customers, you know, continue to transact.
Right, Dan, but I do think that part of this is I would encourage everybody to go one step further. Everything you said is exactly correct. I would go one step further. And that's why I keep going back to this basic unit of analysis, right? Because the accounting numbers themselves, so I know we're talking about sales and margins, but the accounting numbers themselves can be a little bit distorted, right? So another way to think about that is we know that free cash flow, right, which is the lifeblood of valuation, is basically earnings minus investments. And so one of the questions is when we start to conflate, when some of our investments show up in our earnings calculation, right, as expenses, should we and can we recategorize that effectively? And I think that, we spend a lot of time on that stuff. And I think it doesn't affect the ultimate free cash flows, but it gives you a clearer sense of, to your point, what is an investment? What is the return on that investment? What is happening in the traditional sort of core business we have? I think that's just a really helpful thing for people to think through. And so again, I know you guys are talking to the accounting authorities to try to get them to think about, can there be better disclosure in some of these areas? I don't know. It's a high priority for those guys, but I think it's in some ways as a company or as an investor, it's an opportunity, right? Because if you have a good way to think about this and you can pose the proper questions, you may be able to glean a little bit of insight that others are just not paying attention to or pricing in.
Yeah, the area of disclosure is a tricky one. Oftentimes, what they'll say is, as you know, listings here in the U.S. have been way down, and we're losing a lot of market share. And so, if we ask for all these onerous additional disclosures, they're like, "All right, well, fine, I'm just going to list somewhere else." And so they're saying, "Don't make it harder, make it easier." We don't want to scare everyone away even more than we already have. But yeah, and then you speak with the CFOs, and the tough part is they often want to keep, they want to pay less in tax. They want the present value of their taxes to be low, and so if you expense immediately relative to in the future, I think there could be some argument to be made that the tax shield, I'm assuming it could be larger, if all that money is being expensed up front.
So by the way, Dan, we did that calculation, right? Because like revenues from corporates is way down as part of the U.S. Revenues. Do you know the story of AOL and AOL's capitalizing customer acquisition costs in the 90s? Do you know the story?
I am not familiar with. I do know. Yeah, this.
You should make a little note of this, right? So what happened was in the late 1990s, AOL decided, customer acquisition was an investment, so they capitalized it and then amortized it. And the SEC came back. And so what happened is their earnings went up, right? So they went from losses to lesser losses. So that wasn't okay. But the SEC charged them with they said this is so uncertain. You can't really prove that this is going to be an investment that's going to pay off. It was classic, the R&D argument from the 1970s. And they actually made them pay a fine and reverse their accounting. So isn't that's worth that? That'd be going, you could tuck that in for your students. That's a really interesting story of, you could debate, but I think AOL was probably a step in the area toward the truth, right? And so if we waved a magic wand tomorrow and said, all these intangible investments, which are very significant, are now going to be capitalized and then amortized, to your point, it would expose a lot more profits to taxes, and the taxes paid to the U.S. and other entities would go up quite a bit. Actually, I think it's in the tens of billions, if not hundreds of billions of dollars. Anyway, so there you go.
Mm-hmm. So do you think then would it make the most sense to basically have two sets of books? The one where you're paying less in taxes, but everything is being expensed immediately, and then internally, as you're thinking about how you run your business, I don't know if it's just the internal management accounting, but that's where you have the predictive model and you're kind of capitalizing things.
Yeah, I mean, I don't know if you need to have two types. I mean, it's awesome that we basically can expense all this stuff. So in a way, it's good. I just want to keep my eye on the ball. By the way, the other thing is in the United States, part of the 2017 tax law, R&D is now, do you know this? R&D is expense on the income statement, but it's amortized, it's capitalized for tax purposes and amortized.
Wow.
Yeah. So there are two sets of books already for R&D. So R&D is expense on the income statement, but it's capitalized and amortized for tax purposes. So companies are paying much more taxes already for especially for R&D intensive companies. There's another little tidbit for you, Dan.
Geez. No, I got it. I'm taking notes over here. So if they're doing it for R&D, why? I assume then they must be talking about, because I mean, in some sense, we'll say that the money that you're spending on performance marketing, I mean, it's directly bringing the customers in.
Right. No, exactly. So I think what happens in these things is that it's you're doing trade-offs, right? So the 2017 tax act. I think they were trying to say like, oh, we're gonna cut taxes, but we need other sources of revenues. And there's a way to do it in a way that seemed like it was not a super big headliner, right? So it doesn't change your tax rate and all that stuff per se, but it does change the taxes the company pays.
Maybe just to kind of keep riffing on this, one other thing that we've seen kind of emerging, obviously higher interest rates these days have thrown a little bit of cold water on this, but the trend of kind of these specialty finance companies that are helping monetize the customer relationships. And so you've got companies like Pipe that have created marketplaces where you have existing customer contracts and you can kind of sell the right to revenue from those contracts over certain windows of time. Companies like CapChase that are they're kind of first party lenders where they're just kind of buying it themselves instead of listing it on an exchange. And then companies like General Catalyst with their customer value fund that are funding the sales and marketing and then getting a piece of the revenue from the cohorts that were acquired in those periods of time. Super cool. But just, again, when you think about that from the perspective of what we're talking about here, just kind of love your thoughts about how that kind of dovetails in with some of these themes.
Yeah, I mean, I don't follow that super closely. We wrote a little bit about Pipe in one of our reports, but a couple things that I find interesting in the last half dozen years or so is that a higher percentage of these deals are now software deals. So something like 20-25% of buyouts are in the software space, which, by the way, back when I started, it would have seemed like it was crazy. So you say, like, why would that be the case? And this is something, again, you know much more about than I do, but I think a lot of these companies, especially if they're customer SaaS businesses, they have more predictable cash flows, right? So they have predictable revenues. And so if you have a predictable stream of cash flows, that means you have a chance for securitization in a way that might make sense. So then you say, well, statement of cash flows tells us we have operating, cash flows from operations, cash flows from investing, cash flows from financing. And typically, if you're a young company, you may not be making a ton of money. You're investing quite a bit of money, right? So you're not going to look good on that. So you have to finance your business. And so the question then, you step back and say, well, what's the most effective way to finance my business, right? So is it to issue equity, which would be dilutive? Is it to issue debt, which may create essentially a fixed cost? Or is it to essentially securitize some of my revenue streams, or, like you mentioned, SG&A or whatever it is, in such a way? So the key is to sort of, and I'm sure it's different for every company, but sort of figure out, are there ways that we can finance our growth in a way that's intelligent, that builds the most value overall? And I think the cornerstone of all that, I think, is sort of the predictability of the revenues, and that's something we probably have, again, with these subscription type businesses, probably better stability or visibility, at least for a few years, than we've had in years past. Is that right? Does that sound right to you? Or
yeah, that does. Yeah, I think just as we're talking about the accounting, it could be kind of, again, there's like a whole accounting angle to how all the financing is put on the books. But if you're kind of spending the money but then getting it back, and then you're paying effectively this stream of payments that is a function of the revenue that you would have brought in from those customers. It is kind of one way to almost, semi-amortize,
Exactly.
Yeah. So, so we're getting there, but yeah, I do feel, I don't know kind of what your sense is. I think your sense sounds similar to mine, that the regulatory authorities is probably they're not going to be the most helpful people to speak to. I think the change is going to be coming from getting investors to kind of push on the companies to make some of these disclosure changes. Obviously, they can't really make the accounting changes without facing a situation like AOL, but certainly, disclosure.
Well, the disclosure, I think there are two issues, though, Dan, and you're much closer to this than I am. But one is, what you're willing to reveal to investors, right? And when obviously you're revealing to investors, you're revealing it to competitors. So there's a lot of sensitivity around that. But the second is, are companies truly measuring the stuff they're supposed to be measuring in the first place, right? And so, like you mentioned, you guys talk about C3 charts, for example, which are really powerful. They're visually powerful. They're very informative. How many companies really do those the way they're supposed to, A to Z? And by the way, a lot of these are digital first companies. So they do, and they're young. So they should be able to do all this stuff. And so that's an interesting question. And part of it is, are they measuring the right stuff to begin with? And then second, are they disclosing appropriately? Because on the disclosure thing, I get it. I mean, I do get the point that, if you're disclosing something that might jeopardize your competitive position, that would be something that would be a worry. Now, I think the research on that shows that typically is not a big as deal as companies think it is, but that would be something I would think about.
Yeah, that's it's something that we've thought a lot about as well. I think our general sense too is, the academic literature wouldn't suggest there's a whole lot of cost, and especially there's a whole lot of precedent for some of the measures. I mean, there's just many dozens or even hundreds of companies that disclose active customer counts and things like that. So the C3, that comes up a little less frequently, but it still comes up frequently enough that clearly if there was major damage being done, that they likely wouldn't be putting it in there. So but that's really helpful. Maybe just kind of dovetailing a little bit, just to when we think about adoption, customer adoption, it's kind of this tricky thing that you've seen the customers that have adopted so far, but how you think about adoptions into the future. Just kind of love to hear more about it. Ties in a bit with the concept of base rates and how adoption 5-10 years from now is something where I wonder how we can use base rates to help inform that.
So, I mean, a few things come to mind that I think are important. And again, Dan, you know more about this than I do, but the first thing I always like to think about is, just go back to classic economics and supply and demand curves, right? And so when you think about a demand curve, for instance, what you're trying to do is identify, what is the demand at a given price point, right? And, the higher the price point, the less the demand, the lower the price point, the more the demand, right? So that leads automatically into a discussion about willingness to pay and thinking about willingness to pay. And so that, I think, is an important concept to always bear in mind, which is what is happening with the relationship between price and willingness to pay. And if a company is able to increase willingness to pay, and there are different mechanisms to do that, and we can talk about that maybe a bit, then that actually opens up potential customers in a way, because there's more value. But if they are struggling with willingness to pay increases, or they're raising prices, that actually diminishes the population of potential customers. The second thing I always think of, and there are probably lots of limitations, but it goes back to Everett Rogers and diffusion of innovations, right? So just like these patterns of adoption of various technologies or softwares or whatever it is. And, I think that none of that is perfect, especially when you start to get into things like you mentioned, like repeat purchases and customers coming and going and so on and so forth. But as a rough sketch, it's one way it's useful to think about it, because the people who are going to buy your product or service first are the most enthusiastic about it. And they're increasingly less enthusiastic about it, right? So what that would suggest is ultimately you're going to have people lower willingness to pay and maybe higher customer acquisition costs. And so on the margin, it's probably not true for all companies, and there might be other reasons that offset this, but on the margin, it seems like the incremental customer may not be quite as good as the one before. And then I do love this idea of base rates. As you know, I'm very enthusiastic, and just to level set on that, a base rate basically says, rather than thinking about like sort of the unique situation I'm facing, I'm going to think about my problem as an instance of a larger reference class. So in effect, I'm going to ask what happened when other companies were in analogous situations before. And so to the degree to which you have a diffusion of an innovation or a growth rate for a company or whatever it is, or customer acquisition rate or whatever it is, and there are other analogous situations in the past, they can help inform you, right, about how good it could be or how bad it could be, right? Now, we're very, very fond of using base rates, especially for sales growth rates. And obviously, because much of what the work you do sort of gets to the sales growth rate in a way that's intelligent, we can check that. We can do a little bit of a reality check. One example we talk about often in our and this is years ago example. So this has nothing to this. I want to be really clear. It says nothing about the virtue of this company or the stock, but we talked about it for Peloton, right? So Peloton is an example of one of the great beneficiaries of work from home. And so 2020, they're killing it, right? They did $1.8 billion of revenues. And there's an analyst report that came out in September 2020, right? So a little more than 3 years ago. And the analyst projected 30% growth for the next decade. Right now, And by the way, it was serious. Like the guy had a great model. I'm saying like I'm not making fun of it. It's like a great model. Here's the connected fitness bikes, and here's treadmills, and here are the international markets, and so on and so forth. It's like a very thought through and substantiated argument. And then the question we just asked is of companies with $1.8 billion revenue, how many have ever grown 30% a year for 10 years? And the answer was like, 2% or something, right? So not that it was impossible. And if you were super bullish, you might say, oh, I think it's a 10% or 20% probability, but it wouldn't be your base case, right? Almost certainly would not be your base case. So again, it's a little bit of a sobriety check, especially when people are overly enthusiastic about stuff.
Mm-hmm.
So that's another way I would think about base rates as a way to triangulate that. Now, companies, it's an interesting, I'll just say, by the way, I'm reading this Elon Musk book. I don't know if you've gone through this. Like, if Elon Musk actually believed in base rates, he would have done none of the stuff he's actually done. So in some ways, like suspending belief can be helpful for new product launches and all that kind of stuff. But when you're an investor or even an executive, it's a good sort of reality check in terms of what you think you can achieve based on what we know from the sweep of corporate history.
Mm-hmm. Yeah. I bring it up because it really ties in with what we were just talking about with disclosure and how base rates, they're powered on the ability to have other companies where you have the requisite data, to be able to form some prior belief that, represents what would typically happen with the average company in that situation. I guess the good thing is, as you mentioned, we do have pretty decent data on prior technology adoption curves. And so, obviously it's not to say that represents what would happen for, a company launching a product, but, you'd imagine that some of the analogy can hold. So that could be a source of data that we could look to. I think, some of the challenge with some companies is, we don't have a whole heck of a lot of data on customer adoption, but that it could be really, really helpful for everybody if we were to go back and just do a wide swath of, data collection and to find all the prior, disclosures that have been put out there and use those to help create.
Yeah. So Dan, I know that you're not a huge fan of this, but something I've always found interesting, or at least intriguing, is the Bass diffusion model, right? So Frank Bass came up with a diffusion model in the 1960s, which is based on Everett Rogers, right? So it's a 3-parameter model. And I think it's got a lot of limitations, to state the obvious. One's a coefficient. You probably remember these: coefficient innovation, coefficient of imitation, and then basically the size of the market. And by the way, the coefficient imitation is the most important by far. But the only reason I bring that up is that because it's been around for 50 or 60 years, there are a lot of parameters, empirically fit parameters for that. So you can read papers where people have seen the diffusion of, I don't know, it's like 50 plus technologies in that model, right? So again, understanding there are a lot of limitations to that model, but that's the spirit of that work, I think, is what you're talking about, and that absolutely makes enormous sense, right?
Yeah. Just to mention on the Peloton example, I remember this was kind of back when they were 130, 140, and the stock price had been going up like crazy. There was another report that came out saying the market implied, again, just going back to expectations investing, his estimate of the market implied retention or expected lifetime of a customer was something at like 25 years. And I think that's just another area where you think about base rates. We may not have great data on expected, subscriber lifetimes, but you hear 25 years for the average customer, that means that you got all the people who leave after 5 years, physical mortality, all sorts of things. It means that there's a whole bunch of people who would have to be subscribed for like 40 years. So that
and Dan, this is a good. I mean, we should just make sure we make this like sort of hit this with a 2x4, right? Which is, this is why I think expectations investing and customer-based corporate valuation is so powerful together, right? Because the expectation investing can say, here's what has to happen for this to make sense. As you point out, this particular investor was talking about this particular longevity of the customer, and you're now providing the tools and frameworks and history, knowledge of what's going on to essentially weigh in on the likelihood or possibility or whatever it is. And so to me, this is like an incredible. I know we talk about writing something together, but this is an incredibly powerful 1-2 combination, and both of them are better together than they are just by themselves. And so I think it's just, and obviously I'm mostly coming at the world from public market, but even if you're a buyout firm or whatever, a private equity firm, this is obviously too the same thing. If you're going to pay X for a business, you have to say, like, what do we have to believe? The thing I mentioned on disclosure, just as a side note, is it is interesting. You know, we had this little SPAC boom in 2020 and 2021. So a lot of SPACs came out. And now we're seeing this, obviously, that a lot of these companies were using, because they had less regulation or regulatory scrutiny, they were using sort of estimates of things that were just, in retrospect, completely bonkers. And they, at the time, you could see that they were not even remotely close to what the base rates would tell you were plausible, right? So you have, you know, that's a good example. So almost like not quite now real time, but just a few years ago, you could just sort of read these things and say, like, that's just not happening, given what we know about the history of corporate performance.
Yeah. I know we have a whole bunch of questions in the Q&A. Yeah, I've been kind of sorting through some of them. You know, one question that was kind of interesting from Zong Peng was, any valuation approach has its limits. It could be CBCV, multiples, DCF, asset value, earnings power value, total return method. In terms of when you think about the conditions under which one approach might be the most appropriate for a particular situation, just be interested in your thoughts about that. I mean, obviously, I would say for the customer piece, if you have no customer disclosure, you have no data to work with. So I'd say maybe that would be a quick one for that. But love your thoughts.
Well, you know, I'm a guy who wrote a report called "Everything's a DCF Model," so that revealing my bias right at the outset. And what I've argued, I've argued many times that multiples have lots of limitations, and sometimes people construe that to mean that I don't use multiples. I actually don't mind multiples. It's just that what I mind is people not understanding what the multiple implies about corporate performance, right? So if you're grounded, I tell my students, you have to earn the right to use a multiple effectively. So I think everything can be distilled back to a DCF model at the end of the day. Now, the one thing I will say, Dan, and you and I have talked about this a bit as well, is that when you get into a DCF model, if you say, what is the biggest objection, it's usually the residual continuing terminal value problem, right? Which is typically people will model out 5 years, 10 years. By the way, the modal forecast in a DCF model is 5 years. And I think that 5 years, the history of that came from private equity buyouts, right? Because those are typically the average holding period of a buyout. A company was 5 years and then you blew it out, right? So the exit multiple was going to be, right? And so as you know, especially when you talk about 25-year like customer lifetime, having a Peloton for 25 years, that's often too short and it's not capturing it. So as a consequence, we end up putting a lot of value, or in the investment community, a ton of value in the residual value, continuing value. And it's not uncommon, as you know, for the continuing value to be 75% or more of the value. So that's a really fascinating question, is like, how do we get around that? And by the way, I was trying to figure out the history of like terminal values, like where they came from. And it's really hard to trace back, but the first reference I could certainly see was John Burr Williams in 1938. So it's been around for just under a century. And I think part of the reason it came about in the first place is because it was computationally a pain in the ass to forecast cash flows 25 years into the future, right? Like, it was difficult to do. So one of the areas that I think is really interesting is to just not have residual values and just forecast cash flows out 50 years or 75 years, where basically it doesn't make any difference. And I know that's something you've done, and I actually think it's a really interesting thing to do. And it also, again, gets in the same thing. It compels you to think about total addressable market. It compels you to think about, if a current customer quits today, what's the likelihood he or she comes back at some point in the future? All these kinds of questions. It compels you to think about, if I'm based in the United States, what happens if I become global, and so on and so forth, right? So to me, that multiples are okay if you understand the underlying economic assumptions. I do have a aversion to things like LTV to CAC if they're too simplistic, because again, all things being equal, better than nothing. But I really want a more holistic multiple, or a holistic view of things. So yeah, that's probably what I would say. And again, the data issue, if companies don't know this, you have to ask, what is the foundation for them to be making decisions, right? In other words, if you're allocating capital, hopefully, I'm not saying everybody's models are correct, but you're allocating capital, hopefully you have some sort of a model that speaks to the economics in a sensible way to make informed decisions, right? They're not all going to work out, but you want them to be informed at least by what matters.
Yeah, so bottom line, don't cheat.
Yeah, don't cheat. I mean, yeah, exactly.
I'll just put one other out there. Don't do EV to customers. You'll see this show up sometimes, but it ignores future customers. And so people often say, oh, yeah, $50,000 per customer. Yeah, that's crazy. And I was like, well, again, just speaking to the notion of current customers and future customers, if you expect them to, have most of the value coming from future customers, there's no, that could be very rational. So you probably don't want to do that without, looking into it a little further. But I think we're almost at time here. I'm getting the
Yeah, I'm the equivalent of the hook.
okay.
But I do want to just say, like, watching all the Q&A come in, I think we need to schedule a part 2 on this. And I'm having dialogue on social media. Folks are pretty enthralled with what you're talking about. So maybe we'll do that again. And we'll certainly try to address some of the Q&A in other forums and channels as well. So I guess, Dan, if you want to make a couple just quick parting comments, and then we'll wrap it.
Yeah, obviously we've covered a lot. I think just kind of starting with Michael's background, diving into expectations, investing, and current customers versus future customers, how the customer can be weaved into that framework. Super powerful. And then obviously a lot about adoption, base rates, the expectations, infrastructure. I think that these are the ways that we'll be able to bring those two concepts together and do it in a practical way. So, and hopefully, as you can tell, we've been wanting to write something together. I'm optimistic it will happen. It's just a question of when. So
thanks, Dan. I just want to say that, just to be clear, that I'm a very grateful student of yours. I've learned so much from what you've done and your collaborators, and I really appreciate it. I think it's been it's a huge step in the right direction for us and as an industry. And so keep up the great work. And I know that I know you got a lot of continuing ideas, but I've benefited so much from learning from you and talking to you and your generosity. So I appreciate it.
Well, clearly, likewise, the feeling is very mutual. It's just reading through all of this old material of yours, just in preparation for speaking with you. So it speaks to how much I've been learning from you. So yeah, thanks everyone for joining us, and we'll make sure to get back to you on the Q&A for those who we didn't respond to. Hopefully, we'll have the ability to do that in some form. Either by email or just kind of following up with you. So so thanks again. Happy Friday, and looking forward to speaking with you soon.